Buddy, thank you for joining us today for this Tuesday, November 29th. Excuse me, sorry about that. I'm Robert Theobald. I'm a small business ombudsman and vice president of small business services here at the Arizona Commerce Authority. And we're glad to have you with us today. We hope everybody had a great Thanksgiving weekend, enjoyed the time, and with if you're able to join family or friends. Hopefully you weren't like me under the weather the whole weekend, but I'm feeling better today, so I'm glad to be here with you. Again, last week we took off for the Thanksgiving weekend, and we are glad to be back as we wrap up our last few sessions for this calendar year. But today we've got a great session planned for you, and we're excited to have you with us. To start, for those that are new, we'd like to start by recognizing all of our community partners. We could not do these webinars without them, their time and their expertise. We've got well over 100 community partners, and over 200 presenters have been with us on the boot camps. And again, we are so grateful for their time and their effort. For those new to the boot camp, it is a webinar series that we do every Tuesday morning, designed to help small businesses as they prepare, plan, and grow. It is a statewide initiative supported by all those community partners. And not only is it the webinar that we do every Tuesday, it is a content library and a series of workshops. So the workshops we wrapped up in November, earlier this month, but we are planning to do them in 2023. We'll have at least 4 workshops, if not more. So be on the lookout for those. The workshops are longer than an hour webinar. They're usually going to be 2 to 3 hours, half day. There may even be some full day web workshops as part of that series. But let's jump into the content library, because this is an amazing resource available to everyone at no cost. So the content library is where we house all of our recorded webinars. And since we started these in April of 2020, we have been recording all of them. There's just a handful that we could not post due to licensing agreements with the presenters. But nearly 250 or more of those webinars are listed on the content library and available to you to review at any time. You can find the presentation as well as the slide decks that were used by those presenters. So check that out. Additionally, the ACA has a number of programs that can help support small businesses. We have our small business services, our workforce, and our Arizona MEP, our manufacturing extension partnership. Along with those programs, we have our small business checklist. And this is an amazing resource for entrepreneurs looking to start a business or looking to expand their business into other areas. And it can help you identify the commonly requested licensing, registration, and compliance requirements at the local, state, and federal levels. Now with that, we want to talk about some updates and some things that are going on we want to share. I'm going to kind of do this backwards here. First, I found a nice little link that the IRS has, and we're going to share that link in the chat, to steps to take now to get a jump on your taxes. As we're getting close to the end of the year, I know we don't like to think about it, but the sooner we get our taxes done, the sooner a lot of good things can happen too. So we want to make sure we are taking care of that, wrapping up the year strong. And then another thing regarding taxes is on December 14th, the Mojave Community College Small Business Development Center and the ACA were hosting a webinar together. It's going to be on their platform on the ERC, the Employee Retention Credit. And this is a really important webinar, because I know many of you out there have heard the commercials from companies that are saying they can get you lots of money, and they may be able to. But the IRS recently sent out a warning about there are, unfortunately, because there's so much money that can be had, there's some unscrupulous companies out there trying to say they can process this properly and then end up not doing it correctly, but taking their cut and leaving the businesses with some refunds that they have to pay because it wasn't calculated correctly. So this webinar, it's not going to be an exact how-to, but it's going to give you information to understand it better, so you can work with your accountant or another reputable firm to take advantage of the employee retention credit. It can be significant, the funds. I know some of the data out there is suggesting that the average refund is over $100,000. Now, again, that bases on the number of employees you have and the amount of payroll taxes you have paid. but if you have employees, this can be a beneficial thing. So I would definitely take a look at it. And that may be limited in the number of attendees on their web format, though it will be recorded. But if you're interested, definitely take a look at that webinar on December 14th at noon. So with that, we want to talk about some of the webinars we have up until the year end. So next Tuesday, we have Tackle Year-End Financials and Prepare for 2023 with our friends at the accounting firm of REDW. And then on Tuesday, December 13th, we have Business Success Planning. And this is with Jonathan Mabb. He's a financial planner with North Place Wealth Advisors. And what's important about this one is many of you out there are looking at or wanting to at some point in your professional life to sell your business. And Jonathan's going to talk about strategies to help maximize the value as you're preparing or looking ahead. And when you want to go sell your business, you need to definitely plan many years in advance in order to maximize the value. So this is going to be really a good one for those that may be looking to sell your business in the next 2 to 5 years. Then we're going to take a few weeks off for the holidays and then return on January 10th. It may seem late, but the first Tuesday of January is like January 2nd, 3rd. So it's right after the New Year's. So we want to make sure everybody's recovered from a wonderful New Year's weekend before we start back. So we will return on January 10th. So with that, we're going to jump into today's session. We have today Vicky Johnston. She's a business owner and Small Business Development Center analyst at the Cochise College Small Business Development Center. We're excited to have them with us today. So you'll have Vicky, and then you can also see on the screen we have Mark Schmidt, who is the director of the Cochise College SBDC. So with that, I'm going to go ahead and turn the time over to Vicky, and we're going to get her presentation going.
Good morning. I'm Vicky Johnston, and I am a business analyst and a small business counselor down here in Sierra Vista, southern part of the state, for those of you that are in other places down in Sierra Vista. So I wanted to, I've been working with small businesses and accounting all my life. So it's been a long time. We don't have to go there. So I have been working with small businesses at everything from retail to construction companies, to doctors' offices, attorneys, all kinds of things. And those are my favorite people to work with, small businesses, because we are some of the hardest working people out there. We spend the most time, and we have a passion for what we do. But what I found throughout all the years that I've been working with people is you're very, very good at what you do. Whatever it is that you do, you're excellent. But whoever taught you about accounting? Wait a minute, nobody told me I had to learn about accounting. And what do you mean I have to pay small business taxes and sales taxes? So hopefully today we're going to talk about why we have to do this. How does it help you? And what I want to do is give you some key terms to help you understand what it is you're doing and how to use it for you, and make this a tool for you to help run your business, because I promise you it is very, very important. Even though it might be one of the least favorite things that you do, it's going to be the most important thing that will help you to make decisions and run your business. You need to make decisions in real time. And if you don't have any numbers, how can you make those decisions? So hopefully we'll, like I say, we'll talk about the key terms, how to use it. And hopefully by the end of today, the end of the hour, I will change your mind on the value of accounting. How's that? Okay, can we go to the next screen, Faith? Oh, I'm sorry. I also wanted to say that there are small business development centers in every community college here in Arizona. So we'll be happy to help you, but you should have a small business development center in your county, in your community college. So give them a call. They'll have the same type of people that are there to help you, just like we do here down in Southern Arizona. Okay, so what we're going to go through is, the first thing is, it's a requirement by the IRS that every business keep records. You have to keep records if you're going to be in business. if you think about it, how this works is, let's just say, for example, if we make $20,000 in the year and we take off $10,000 of deductions, business deductions, we end up paying taxes on 10,000 instead of the 20. Now, if you work for if you're a wage employee and you make 20,000, you're going to pay taxes on $20,000. But as a small business, we do get to take off business expenses. But the deal is, you have to keep records to be able to take those deductions. So it is to your advantage to keep all these records that we're talking about. Now, the law does not require a special type of bookkeeping system. They can't say, oh, hey, you have to do QuickBooks or you have to do a formal accounting system. You just have to have some type of bookkeeping system. It could be a spreadsheet, it could be QuickBooks, but what the IRS is very clear on is that you cannot just use bank statements. And my suggestion is, don't hand somebody a box of receipts. That's not going to go well for you. So bank statements, if you think about it, when you look at those, sometimes you can't even figure out what came through. And that's why they won't allow that, because all it's going to tell you is the date. Maybe you can see who you paid and the amount. That doesn't tell anybody what you actually spent the money on. So remember, you can't just use bank statements or credit card statements for your records. Okay. Your records must show gross income as well as all of your deductions. So whichever system that you're using, make sure you're showing your gross income, which would be the full amount of the invoice or whatever it is you're using of the job. And then we'll show all the deductions too. And remember, you have to have documents and receipts to support these records. Okay, so all of you people that are ordering from Amazon, print that receipt, okay? Amazon's not going to tell you what you bought. So make sure you make a habit of printing that Amazon receipt. Now, your records must be available for inspection by the IRS. Remember, when you signed up for your EIN, or if you are an LLC, everything we signed up for, they ask for an address, a physical address. Where are the records kept? So that's so that if you are audited, they know where the records are being kept. My suggestion to you would be I actually keep a folder for every month, and I put all my receipts in there for everything. And then I get to my own bookkeeping, of course, which is last on the list. But if I ever have, and then at the end of the year, I will pull all of those folders, do my accounting, and then stick it in a box for that year. Okay, so we're going to get to how long we have to keep it in just a minute. So if you are trying to decide, I know you're small business people, and I know that you're busy, and you're trying to decide who does the accounting. Honestly, if you have the time, you are the best person to do your accounting, because you know what everything is, and you're the one that's going to be making those decisions, day-to-day decisions sometimes. That's what, so what I tell people, because even though I'm still, a business analyst and a counselor here at the SBDC, I still do accounting every day for businesses. So I keep my hand in it, so I know what's going on, and that way it helps me to help you a lot better. So your decision on bookkeeper versus yourself, the people that I do accounting for, they've decided that for the amount of time it would take them to do it, they can make more money than what they pay me to do it every month. But at least they still have their numbers that they need. So that would be kind of your decision. Do you want to do it? Or in the same amount of time, can you pay someone to do that for you? Either way, what you need is numbers in real time. Okay, next slide, please. Okay, so for the next question that I get a lot is, how long do I need to keep these records? The rule is 4 years from the date of the tax return. Now that's the date of the tax return, and we're always doing it the year after. So what I tell people is just keep everything for 5 years. Put it in a box, put it with the tax return, keep it for 5 years. After that, then you can go ahead and shred things. Okay, the things that you do need to keep. You need to keep your invoices or your income, however you record that, and your expense receipts. You need to keep employee and payroll records, all of those where you've paid your taxes, where you've paid your employees, including their employee file for those same 5 years. The only thing that would be different is something that's bigger and more long-term. Like if you have a loan, you want to keep that till it's paid in full. If you have land and assets, you'll keep those records as long as you own them. So don't shred those guys, okay? All right. Who's going to use these records? Number one, you, the business owner. You're going to use these records to make decisions. Your accountant, your tax preparer, they're the same people that need these records and this accounting that you're going to do. What if you want to get a loan? Your loan officer is going to want to see a lot of these same things that you're keeping. So these are the kind of things that you need to keep. All right. So what can records tell me? Next slide, please. Your records will show you the progress of your business. They're also going to show you problem areas that, maybe you thought you were doing better at that. But once you start doing some records or accounting, I promise you numbers won't lie. As much as you want them to, they don't lie to you. Okay. You can compare expenses to income for a specific period of time. If you need to see, like, how did we do last year compared to how we're doing this year? Or how did we do last month compared to how we're doing this month? It's going to help you make management decisions such as, can we afford to hire another person? How will you know that? You're going to go back to your accounting. Can you afford to expand your business? Anytime you're thinking of doing any of these kind of things, go look at these numbers and see how much are you making. Can we afford to pay for a loan if we get a loan? And what are our actual costs to run this business? So that's what this accounting is going to tell you. And these are all things that small business people need to understand every day. Okay. All right, next slide, please. You'll use these records, these same accounting records, also to pay monthly sales tax. If you collect sales tax, you'll need them for that. All of your payroll taxes, you'll need your accounting. You'll also use it to pay self-employment taxes during the year. You pay them every quarter. But how would you know how much to pay if you don't do your accounting? If you want to apply for a business loan, you're gonna need these numbers. Most loan officers are going to ask you for a profit and loss. They'll ask you for a balance sheet, and they'll also ask you for a couple of years of tax returns. So you're going to need them for all of that. If you want to apply for a credit line with a vendor, they're going to want to see some numbers. If you apply for a credit card, they'll also ask you for numbers, or maybe just credit with your vendors. All of these people are going to ask you for the same thing. Now, later on, when you decide to sell your business, how will you know what to ask for this business? How much should you ask for this business? That's when you're going to look at your balance sheet, which would be your assets, all of your assets, your liabilities, and your income and expenses. That's how you're going to price your business also. So you're going to use these same records to do a lot of things that you're doing. Okay, next slide. Okay, let's talk about some accounting terms that you're going to run into whenever you are doing anything, applying for a loan, that kind of thing. I get a lot of questions on cash versus accrual. Most small businesses are on the cash basis accounting. And so what that means is that your income is reported when it's actually received. So you could send out a bunch of invoices at the end of the month, but you're not going to claim your income until they're actually paid. Your expenses are reported when those are actually paid. So that, to me, it's a much cleaner system. I don't want to record income if I haven't received it yet. And I don't want to record an expense until I've actually paid it. So the accrual basis accounting, which is for businesses that are much bigger, that income is reported when it's billed to your client. So when you send out all your invoices for the month, you're going to record that as income in your profit and loss. To me, what if I never received some of those? Have you ever heard of the bad debt expense? That's kind of one of those things when people use the accrual accounting system. Because when you use the accrual, you're already claiming the income, which means that you also have to claim the taxes on it. All right. You report your expenses when they come in, not necessarily when they're paid. So that's one of those big terms that's pretty confusing for most people. But if you're out there, talking to bankers or loan officers, I would like for you to have these terms that you know what you're talking about, and it makes sense to you. It'll just make you look better when you're applying for anything. Okay, next slide, please. Okay. For those of you that haven't started yet, or you're thinking about starting a business, I would suggest that you do a cash flow analysis. That's another big word that a lot of people don't understand. Like I said, you're really good at what you do, but who taught you about this stuff? I would suggest that you use a cash flow analysis. We have them. And if you'd like, we can send that to you afterwards. And what that will do before you've even started, it's where you're going to project your income for the month. And you're going to do that by doing research on businesses of this type and typically how much they make. So you would project your projected sales, and this is for 12 months, okay? Your sales monthly, and then you would project your expenses. And how can you find out what those things cost? You're going to do a lot of research first. And that's going to give you a better idea of how much you expect to bring in monthly. You'll also have the expenses that you've researched minus the expenses. And when at the bottom, that's your cash flow analysis. And if you do that for a whole year, you'll have a much better picture of what will it cost you to actually start and run this business before you ever get going. So I would suggest that you do that. And that's what a cash flow analysis is for you to do that. And even if you started in business, you could still do one of these to see how hopefully the rest of your year is going to go. And that way you could make adjustments and change things if you need to. Do we have any questions yet so far? Cool. Okay, so next slide, please. Yeah, I'll be happy to send you the spreadsheet, and we'll have our information at the end on the slides where you could email us or call us, and I'll be happy to send you the cash flow analysis.
Also,
I
Vicky,
like it. Huh?
So everybody knows, we will include the forms that Vicky's talking about and the Excel spreadsheets and stuff as well with the recording of this webinar. So that will be in the content library later today or tomorrow.
Good. These are things I've developed over the years to help people and show people when I'm talking to them. Okay, your profit and loss statement. For a small business, this is the one you are going to use the most. And you can use it any day, anytime. A profit and loss shows the company's income, all income, minus your operating expenses. And profit and losses are for a specific period of time. You could do them from January 1 to now and just have that set of numbers. You could do them quarterly. You can do them monthly. You can run these reports to compare to last year. So this is a report that you're going to use a lot as a small business and make some decisions from too. So what I want to do is give you an example of some different profit and losses and how to use them. Okay, next slide. All right, this is your basic profit and loss. This is what you get from a lot of accountants, bookkeepers, that kind of thing. And as you can see, it shows your profit and loss shows you totals, doesn't show you the detail, but the total comes from all of the detail that's behind your numbers. That's it'll show you your all of your day-to-day numbers, and that at the end of the month, that is what you made. So it's 42, 45, 13. That's your sales. And then underneath, and profit and losses are always in this format. Sales, income minus expenses equals a net income or a loss. So your expenses are all the things it takes for you to run your business. So right now we made 42, 45, but we spent 43, 48 this month. So we actually had a loss this month. Now, of course, the rest of the year could have been better, and you just had that 1 month where you had to buy extra things or whatever. But this is mostly what you see, and this is your basic profit and loss. Now, I personally would like to see some detail in these profit and losses. The 42.45 is not telling me where did I make my money. It's really not helping me a lot. It's okay, but it's really not as good as I would like it to be. And I'm not learning much from that, other than that's my total sales. Okay, so what I'd like to do is show you a couple of different profit and losses, which I think are better to do. It does the same thing, but we have more detail in them. So can we go to the next slide, please? Okay, what if you're a little auto repair shop? Let's put some detail into our numbers. If you do service work, and we do lube oil and filters, we do brakes, and we do tire sales, isn't it better to see what we're making from each major line that you're bringing income on? I would like to know how much am I making in each one. The 81, 88, 55 is not as helpful as splitting out all of our different major income lines. And for each business, you can set up your own type of income generators. And as you're doing your accounting, you would split those out into that kind of income for the month. And that's going to help you a lot more. What you're going to decide from this is, hey, and then you also want to split out your expenses. Now, you don't have to have cost of goods sold, but if you're the type of business that can, I'm a service type business, so I really don't have cost of goods sold. But for this kind of business, your cost of goods sold is everything that it costs you. If you're doing service work, this would be all the expenses that you paid for to buy the service work items. You would also show how much money did we spend buying our filters, our oil, or that kind of things for lube oil and filters in the same month. How much did it cost us to buy all of our brake parts, our pads, and those kind of things in that same month? How much did it cost us to buy tires that we sold to our customers in the same month? So you're putting in a lot more detail into your accounting because that's going to help you. And what you might decide is, hey, we're not doing so good on the brake work, because you have a direct comparison of how much did we bring in this month versus how much did we have to spend to sell that same work. So you're going to make decisions from this type of accounting. That's how you're going to decide, do we want to do this? Or you could say, hey, we're doing pretty good on our service work. We made $4,000 and it only cost us $1,500 to get all the parts to do the service work. So that's why I say put some detail into your reports, into your type of reports. Think about what type of line items you want to keep track of for income, and then correlate the same expenses to those income lines. And that's going to teach you a lot more than 8188 of income minus 5409 for expenses. Is that making sense to you guys out there? I wish I could see you. It would help me a lot better. But every type of business can have their own detail on income and expenses. So that you know, that's up to you to decide what is your major things that you want to do. For instance, like I said, I do accounting for different people. I also go and do counseling, and then I go work with people one-on-one. So my lines would be counseling, teaching, and then this kind of work here. And so I want to see, you know, how many people am I helping on one-on-one? How many am I doing counseling for? How many teaching things am I doing? And that way, instead of just one number for my income, I've got 3 different things that tells me where I'm bringing my income from. And I really can't think of too many types of businesses that can't use some type of a split for this kind of thing. And then down underneath, gross profit are just your regular standard operating expenses. We call these overhead a lot sometimes. Although we probably could move freight up to the cost of goods sold, because of course we have to pay the freight to get in all of our parts to sell. So design your profit and loss to help you in what it is you want to know. Typically, and also put some detail in it. On the other screen that we just saw a payroll number. We didn't see how much were wages, how much were taxes. We also saw just utilities on that first one. I kind of want to know how much is my telephone, how much is my electric, how much is my internet. I don't just want one number for utilities. I actually want to see where all of my money is going, so that hopefully if I needed to tighten my belt, I can make some decisions from this kind of a profit and loss. Also, you could do the same thing for office supplies. Any one of these you can split out to give you more detail. So you as the business owner, yes, we're doing a profit and loss, and yes, we're showing income minus expenses, but put some more detail in there. So that's going to help you run things and make decisions on a day-to-day business basis. Okay, let me show you one more that just to make a little more sense. Can I have the next slide, please? What if you're a feed store and you sell hay and then animal feed, dog and cat food, and veterinary supplies? So instead of just having sales of $5,014, I kind of want to know how much of those sales were hay, how much of it was feed, how much of it's dog and cat sales, and how much of it's veterinary supplies. And then I'm going to also split out my cost of goods sold in the same type of thing. So if we sold this much hay, how much did it cost us to buy the hay that we did sell? How much did we sell in the feed, the animal feed? How much in dog and cat food? And how much in veterinary supplies? And for me, I would probably start looking at that over a period of time and say, you know what, we're not doing so good on the veterinary stuff. Why don't, let's just go ahead and not do that anymore. It's probably not worth our time and effort because we're really not making that much in it. And then I'd put more stuff into feed and hay sales because those are my better sellers. So that's why you want to do this kind of thing. And so hopefully you're thinking about your business and how you would want to split this out and find out where is my money really coming in. And then you can focus your attention more on that. Those kind of things. And then you have your expenses down farther, just like everything else. We still have our net income or loss at the bottom, but we have a lot more detail behind that. Okay. Questions? Do we have any questions so far?
We do have some questions in the Q&A. The first question from Elizabeth is just about the template. Why are the costs under the income heading?
How it can be done. You mean the cost of goods sold?
Correct, yes.
Okay, how it can be done, and I either is correct. You can have income and then put all of your expenses together, or if you're this kind of a business, what you do is you have your sales and then direct costs to sales, which gives you a net income for sales. So that's how that either way is still correct. But like I said, for me, I don't have cost of goods sold, so I just have income minus expenses. But in this kind of a business, you can do cost of goods sold. So like I said, either way is still correct. So it's a direct correlation to the income where you're going to have your gross profit. Depends on what kind of business you have, whether you do that or not. Either way, the net income and loss is still going to be that same number. You just have, because you know that I made $5,000 and $5,014, but the direct cost to that, meaning I had to buy the product to sell, I had to buy my widgets to sell my widgets. That gives me, because I can't sell the widgets if I don't buy those things. So that will give you your gross profit. You have your gross sales minus your cost of goods sold will give you your, I call it net income. And then you take your expenses, which I consider those more overhead expenses. But at the bottom, you're still going to have net income or loss. Either way that you do it. If we took cost of goods sold out and we moved it down under expenses, to me, it wouldn't be as easy to read and make decisions, but we would still have the same bottom line.
Excellent. Thank you, Vicky. That's all the questions for this section.
Wow. Okay, so let's talk about one last dreaded thing that most people, you're not going to use very often. So let's go ahead and go to the balance sheet. Sorry, next slide. What is a balance sheet? You're not going to use this very often, but it is also important for you. And a balance sheet is the assets that your company owns. Think about all the things that you have bought to run your company. And depending on what kind of company it is, it could be a building, it could be land, it could be trucks, it could be equipment. Assets are things that last over the course of time. So you have two types of asset. You have current assets, which would be checking accounts, savings accounts, things that are liquid, that turn over quickly. And you also have long-term assets. Now, those, like I said, those are the other things, that equipment, trucks, furniture, and fixtures, those kind of things. They will last longer than a year and don't turn over. So assets are actually what your company owns. Okay. And this accounting equation has been here since the beginning of time. I didn't do it, so don't shoot the messenger. Liabilities are what your company owes against what it owes at a certain point in time. So liabilities, we have the same thing, current liabilities, and we have current liabilities and long-term liabilities. So current liabilities would be things that you're going to have to pay out very soon, within a year or shortly after that. Sales tax, payroll taxes, those kind of things that turn over quickly. Okay, long-term liabilities would be loans. Like you have a loan on your equipment or your trucks. Those are things that are going to last more than a year. So we have assets, and that'll give you a number, current and long-term. And usually for assets, you will use either what you bought it for, or if you don't know, it'll be current fair market value. You could put that on your assets. I mean, if you inherited equipment or a truck or whatever, put your fair market value on those. And then your liabilities will be what you owe against it. And that gives you your owner's equity in a business. Now, these balance sheets are your financial position as of a certain date. And balance sheets are cumulative. So they keep adding or subtracting every month. Every time you run one, they'll never be the same. If you do one yesterday and you do one today, they'll both be different because you spent money in the checking account or those kind of things, or you paid off sales tax or whatever. So those are cumulative. Those are cumulative. So who's going to ask you for a balance sheet? A loan officer will ask you for a balance sheet. Any loan officer is going to ask you for that. And also a balance sheet, you would need those for your tax return. And you're certainly going to need that at the end of your business when you're thinking of selling. How do you know what you're worth? How would you know what to sell your business for if you don't take into account all of the assets that the business owns and that you own? And to your buyer, are they buying the assets? So are they all coming or not? And what is owed against this asset? If I'm buying equipment, but it still has a loan out against it, I need to know that as a buyer. But that's also going to help you to price your business and what you're selling. So your owner's equity in the business is your assets minus your liabilities, and owner's equity is just what your business is worth at a certain point in time. Does that make sense? Because this is the most confusing type thing that I get asked about. You won't use it all the time, but you will need it at some time. So my goal today is when you are you're thinking about getting a loan. When you walk in to talk to the loan officer, if you know these terms and how they relate to a business, and you actually bring these things in to start, when you're going to ask for a loan, I promise you that loan officer is going to sit up and pay more attention to you, because you actually know what you're talking about and you can answer the questions that they're going to ask. So think about that whenever you're thinking of getting a loan. Plus, take your profit and loss, and you'll have a better idea of how much of a loan you need, and are you going to be able to pay that back? Because that's the banker's big concern. He wants to see some numbers and to make sure, can this business pay back our loan? And then if not, they're going to look at your assets and look at, well, okay, they have enough assets to cover the loan that I'm going to give them. I promise you, loan officers do not want to come and take your stuff and sell it because they get pennies on the dollar, but they do want to make sure that their loans are covered before they give you a loan. So think about having these things, and I promise you, once you have them and start using them, you're going to be a much better business person, and you're going to be a much better when you, like I said, if you go for a loan, by knowing what you're worth at a certain point of time, you're going to make much better decisions on, can we afford to hire people? Can we buy more inventory? Can we get a loan? And if we do get a loan, can we pay it? What do we owe at this point of time? Type stuff. So numbers will give you knowledge, and I say a small power thing, because you're going to make much better decisions in the long run from those kind of things. And like I said, we have SBDCs all over Arizona, and anybody should be able to help you with these kind of things. But like I said, we're also happy to give you these things that I've included today, and so that you can have them yourself. So do we have any questions out there?
Yeah, we have a few questions that
Sure.
we can ask.
Go ahead and go to the next slide.
Are you done, or you want to ask this at the very end?
Oh, go ahead and ask. Yeah.
So
And
one
one
is,
more.
we take a photo of the receipt and upload it into our time expense invoicing system. Does the IRS accept this digital format, or do you need a physical printed copy?
They will accept a digital format, as long as Now, remember, we are loading them onto electronics, and electronics tend to self-destruct at the absolute worst time. So you want to make sure that you still have that receipt somewhere. If it's not like actually in the physical computer, but you could make a electronic backup of all those things. And I will say that if you're going to be audited, it's never going to be real time. They're so far behind that they're probably going to audit you for a couple of years back. Will you know where to find that stuff? And will it still be available? If the auditor says, can I see the receipt for this expense? Or can I see the receipt for that expense? Will you be able to find that? Will you still have that accounting or that program, electronic program where you did upload it? So that's the only thought there. To me, I know I'm old, but paper is just easier because I stick it in a box and put it in the closet. So that's why I recommend that. But yes, it is acceptable.
Okay, I'm scrolling through some of the questions.
Uh-huh.
Some are a little specific, but there's a good one here that may help some of our small business owners out there. It says,
Mhm.
how are loans calculated? Does the loan money count as income? And do you deduct full payments, or does the loan not get added to income and just deduct the interest? How does the loan factor into profit loss? Do you count the loan money you received in there or not? Gets confusing.
The actual loan amount that you receive is not income. You will put it in to actually your current liabilities that you have to pay back. And then you are able to, because you income is money that you've actually earned from whatever it is that you do. The loan income, yes, it goes into the bank, but it gets put in as a loan, current liabilities. What you do get to take is, as you are paying each loan payment, you will split out the loan payment between principal and interest. And the part of the payment that goes to principal lowers the loan amount in your liabilities. So you'll know at all times what you actually still owe on the loan. And then you get to take the interest expense on your accounting as an expense to the business, but you don't get to take the whole loan payment. You're just going to be able to take the interest portion as an expense. But no, it is not income that you've earned.
Excellent. Let's see. We have some other ones in here.
Faith, you could go ahead and use the next slide so they'll have our information.
Yeah.
Last one. Oh, you must not have that. I apologize. Okay.
So another question, Vicky, that came up, says in order to call out the different income streams, you, as the example, hay sales, feed sales, etc.,
Mhm.
one needs to set up a chart of accounts properly categorizing revenue, calculating cost of goods sold. Is that correct?
And you could do this even if you're still in business now, just pick a point in time where you're going to start creating more detail. But yes, you would need to add more income accounts in all the streams in your chart of accounts, and then set up your expenses or your cost of goods sold in your chart of accounts to mirror your income accounts. So you have a better direct correlation. So if you're using like the QuickBooks program, you would set those up. You might not have had a cost of goods sold now. You could take the other things that you had in your expenses and bring them up to the cost of goods sold area, and then add the lines that you need.
And Vicky, when talking about like cost of goods sold and your really the chart of accounts more than anything, if you're setting that up for the first time, do you recommend connecting with an experienced accountant or bookkeeper to help you set that up properly?
Yes, that would be more helpful in the long run, because it's easier to set it up correctly. But I will say that since the beginning of time, the accounting equation and meaning the chart of accounts is always been assets, liabilities, owner's equity. Those are the first three in your chart of accounts. And then the last two are income and expenses, and those correlate to the profit and loss. And the first three correlate to the balance sheet.
Okay, let's see. This one is, do you recommend a separate sheet for each balance sheet? In other words, not overwhelming the previous. So I might have a separate sheet for December 2nd of 22 and December 7th of 22.
For balance sheets, you don't have to run them very often. It's just things that you can run from time to time. I would definitely run them at the end of each year. I would run your profit and loss for the whole year and run your balance sheet for the whole year also. But what I was saying is that balance sheets change. Anytime you spend money, the checking account balance changes. If you buy a new asset, then that changes as far as your assets. And if you have a loan against it, that number will change. So balance sheet you don't use very often, but you can use at any time. If you're going to go apply for a loan, of course, you would want to run a balance sheet and a profit and loss as of a certain date so that you can show the person, the loan officer that you're talking to. So I would run one, maybe at the end of each year and put with your records. But if you have an accounting program, you can run one at any time, and you can run a profit and loss at any time. And you can even go back and say, what was our balance sheet last year at the end of the year? What is our balance sheet this year at the end of the year? And do a comparison. Same with your profit and losses.
Yeah, great point there, Vicky. I found that in previous organizations where I've had P&L responsibility, looking at those monthly and comparing to prior year is huge to know if you're doing better than the prior year.
Absolutely.
But another thing to remember is all those, the balance sheet and all those are a snapshot in time for when you print them.
Yes.
And so if you've got the checks in the mail, as one of your clients might say, well, if you print that information while the check's in the mail, your income still may be down, and then a day later it might be up. So
Yeah.
you have to remember some of that, but it's a best practice to have those financial statements monthly and compare them to the previous year.
Sure. And I will say that if you are using, and the only reason I say QuickBooks is because I used to teach it. I taught it for years and years. One of the reports that I liked in QuickBooks is you could do your whole year profit and loss from January 1st to December 31st. But then I would also have it show me monthly. So I'd have 12 columns right next to each other and looking at, my income versus my expenses monthly. But what that also tells me is what are the busier times of your year? What's the slower times of your year? When is that big insurance payment due again? So that I know that I got to have enough money in June because I've got to pay for my liability insurance. You might find out that, let's say you were a repair shop, that right now is our slowest time of the year. People are staying home, they're spending money for Christmas. Maybe that's the good time to go ahead and take my vacation. But man, I don't want to take off during the summer because that's some of our busier months. And for retail, you would see your really busy months versus your slower months. So it's going to give you a lot of knowledge and make better decisions for what you're doing.
So I've got a really good question in here that for small businesses, because I know some small businesses do this, but may not be right. It says, do you connect your personal bank accounts to QuickBooks in addition to business bank accounts? I've heard both. I
would not at all. You want to keep that clean. And for one thing, one of the biggest no-nos with the IRS, Arizona Department of Revenue, is commingling personal and business funds. It's just not something you want to do. If you want to keep track of your personal things, then have a separate account in QuickBooks and do just the personal over there, and have another company, your business company, but don't ever commingle the funds. Now, let's say, for instance, that you went to Phoenix and you ended up using your personal credit card, because you saw a great deal on a printer, and so you didn't have your business stuff with you, and you bought it with a personal credit card. What you're going to do is, when you get back, you're going to write yourself a check or go take out, show a debit from your bank account, pay your personal stuff back from the business, and then say in the business what it was you bought. Even though you didn't run that expense through the checking account, what you're going to do is pay yourself back from your business checking account for the business printer or whatever it was that you bought. But do not commingle personal funds with business. If you're going to take a draw, that's an owner draw. If you give the business money, that's an owner investment. Those things do not show on a profit and loss. They only show on a balance sheet as owner draws, owner investment. So to get that expense into the business, you're going to have to pay yourself back from the business checking account. But like I said, owner draws, owner investments, they are not actual expenses to the business.
And Vicky, that's a good point to make, because some people don't realize, but if you commingle those accounts and you're an LLC, a lot of the protections that you got by being an LLC have then been voided because you mix the two.
And you're not acting professionally as a business. Think about this. A lot of times I try and think of as an auditor. Let's say you never started a business checking account. Okay, and you've been using your personal all along, which you should not do. And let's say we have 30,000 in our personal checking account that we're running our business through. But on our tax return, we said, well, I only made $10,000. I didn't make, any more than that. And the IRS, of course, is going to pull your bank account, and they're going to go, well, we see $30,000 in your checking account. Prove to me that you didn't earn 30,000 instead of the 10 that you're claiming. So that is just something that you don't want to do. Get yourself a business checking account, keep it clean. And what they'll say is they're not acting professionally as a business. So that could, cost you your LLC.
All right, we are right at time, so we are going to go ahead and wrap up. There were some questions we didn't get to. I'm going to send these questions over to Vicky and
Okay.
See if we can get those answered directly to the individuals that asked them.
And hopefully I've changed your mind a little bit on accounting. That was my goal today, that maybe it's not such a terrible thing. And you actually will be able to use it as a business owner.
Robert, one final thought too is I saw a lot of the chat questions and stuff, and so much of it is unique, dependent upon your business. And so there's clearly no yes or no answers on it. And so you want to get hold of, there was someone there, the Arizona Department of Revenue, with this $5,000 limit on deductions for starting the business. Who knows, you might have had some things that you were deducting that might not have been a deduction. So you can't say yes or no on that one, but generally no. If you have $1 million worth of business expenses, it's a business deduction. But you want to consult with a professional that understands accounting, and don't try to wing it on your own.
Yeah. I think consulting with an accountant, and then also starting your chart of accounts, starting your bookkeeping right from the beginning, even if you're doing it yourself, is extremely helpful, because when it gets to the end of the year and you have a box full of receipts and you're trying to figure out your taxes, and then you're also trying to figure out, hey, I need a loan this year to grow my business, it becomes much harder to make all that work because of not starting right on the front side. So whatever efforts you can do on that front side to get things set up right is huge.
And please talk to a tax preparer hopefully earlier in the year, because tax people know all the things that we can and cannot take for our businesses. And so depending on your business versus my business, I take different deductions than you will. But how do you know what kind of things you can take off or can't take off on a tax return? Everything that's on a profit and loss may not necessarily be able to go on a tax return, but you still want to know what it's costing you to run your business. So talk to them earlier in the year. Don't wait till right now, because then it's kind of too late. You could have done this or you could have done that, and you just didn't know to use it for a deduction. So an accountant or a bookkeeper and a tax person are very, very important to small businesses. Get all the deductions that you can legally take.
Excellent. And with that, we will wrap up. I want to thank Vicky for her time and her presentation. Great job. Mark, thanks for being here. We want to thank all of you for being here with us today, and we hope to see you next week, next Tuesday morning, 9 a.m. Until then, everybody have a great week and a great weekend when it comes, and we'll see you soon. Thank you.
Thank you for coming. I appreciate it.